In March 2009, a school teacher invested $50,000 at what felt like the worst possible moment in history. That investment is now worth over $500,000. She didn't use any special strategy. She didn't have inside information. She just recognized something that most people completely missed. And right now, something almost identical is happening again. Except this time, the numbers are so much bigger that it almost sounds made up. The wealth pattern I'm about to show you is backed by data from some of the largest financial research firms in the world. It's already been happening for several years, and because most people are too distracted by daily news and short-term market moves, they have absolutely no idea it's coming. By the end of this video, you're going to understand exactly what's unfolding, what it means for regular people, and the specific actions that position you to benefit from it. So make sure to stay until the end, leave a like, and let's start. Here's the frustrating thing about wealth creation events. They're obvious in hindsight. When you look back at a chart from 2009, the bottom of the market looks like a giant, flashing green arrow pointing at the most obvious buying opportunity in modern history. But that's not what it felt like at the time. In March 2009, the financial world was in complete freefall. Lehman Brothers had collapsed 6 months earlier. The S&P 500 had dropped 57% from its peak. Headlines were calling it the worst economic crisis since the Great Depression. Retirement accounts had been cut almost in half. Most people weren't thinking about investing. They were thinking about survival. The teacher I mentioned, let's call her Veronica, took $50,000 she had been saving for a house down payment and put it into a simple S&P 500 index fund at the very bottom of that crash. Her friends thought she had completely lost her mind. Her family begged her to wait. She ignored them. That $50,000 is now worth approximately $590,000. She didn't do anything complicated. She didn't pick individual stocks or time the market perfectly. She simply recognized that fear had pushed prices to a level that made very little sense, and she acted on it while everyone else froze. Now, here's the important part. We are not in a market crash right now. That's not what this video is about. What's happening today is actually a completely different kind of wealth creation event, one that in some ways is even more powerful. And just like in 2009, most people have no idea it's happening. The number is $124 trillion. That's not a typo. $124 trillion is in the process of changing hands over the next 2 decades. And where that money flows is going to create opportunities that will mint millions of new millionaires from completely ordinary backgrounds. I divided everything in 9 parts, and the most important one is part 8. Part 1. What happened after 2009 and why it matters. Let's first understand what happened after that 2009 low, because the numbers are honestly remarkable. From March 2009 through early 2026, the S&P 500 rose more than 900%. In January 2026, the index crossed 7,000 points for the first time. If you had invested $100 at the bottom of that crash, it would have grown to roughly $1,000. But here's the most important detail. The people who benefited most from that run were not Wall Street traders. They were not hedge fund managers or investment bankers. According to the data, the biggest winners were teachers, nurses, accountants, and small business owners who simply kept contributing to their 401ks and index funds while everyone around them was panicking. The numbers tell a powerful story about what that created. In 2010, the United States had approximately 8.4 million millionaire households. By the end of 2024, that number had grown to almost 24 million. The country added over 15 million new millionaire households in just 14 years. Think about that for a second. 15 million households crossed the $1 million threshold in under a decade and a half. That's roughly the entire population of the New York metro area becoming millionaires. And it wasn't driven by big windfalls or lucky stock picks. According to UBS's Global Wealth Report released in 2025, the United States added 379,000 new millionaires in 2024 alone. That's more than 1,000 new millionaires every single day. Most of them got there through steady, boring, consistent participation in rising markets through retirement accounts and index funds. UBS has a name for this group. They call them everyday millionaires, people with between 1 and 5 million in net worth. Globally, this group has quadrupled since the year 2000 to approximately 52 million people. They collectively control over $17 trillion in wealth. the path to joining them is not secret. It's documented. It's repeatable. And right now, a massive force is about to make it easier than ever for more people to follow that same path. Like all the people that follow my path on opening their YouTube channel, since YouTube is the golden opportunity of this decade, and I can help you in my free community in the link below. Part 2, the $124 trillion wealth transfer. What makes the current moment even more significant than 2009 is something called the Great Wealth Transfer. According to research from Cerulli Associates, a financial research firm, approximately $124 trillion in assets will change hands between now and 2048. The research was updated in 2025. This is the largest transfer of private wealth in recorded human history. Nothing in modern economic history comes close. To put that number in perspective, $124 trillion is more than the entire annual economic output of every country on Earth combined. It's more than 5 times the current US national debt. It's wealth that was built up over 8 decades of American economic expansion. And it's about to flow down through the generations over the next 25 years. So where is all this wealth coming from? Baby boomers, those born between 1946 and 1964, currently control approximately 52% of all wealth in the United States. That's roughly $78 trillion concentrated in a single generation. The youngest boomers turn 62 this year. The oldest are approaching 80. Over the next 2 decades, this wealth is going to transfer to their children, their grandchildren, and to charities. Cerulli estimates that approximately $16 trillion will go directly to heirs in the coming years, with another $18 trillion going to charitable organisations. Let's break down who receives what. Generation X, often called the forgotten generation, stands to inherit approximately $39 trillion over the next 25 years. That's roughly $1.4 trillion per year, flowing to a generation that's currently caught between caring for aging parents and still supporting their own kids. For Gen X, this transfer could completely transform retirement prospects that currently look uncertain for many. Millennials will receive approximately $46 trillion. Their windfall comes a bit later, but it arrives at a point when many will be in their peak earning years, meaning inherited capital compounds alongside career income, in a way that's genuinely powerful. Even Gen Z will begin receiving significant inheritances as the transfer accelerates through the 2030s and 2040s. Part 3, how this compares to 2009 and why most people are missing it. Now here's where it gets interesting, because the parallel to 2009 is real, just different in its mechanics. In 2009, 3 conditions aligned to create extraordinary wealth for anyone who recognized the moment. First, assets were dramatically undervalued after a 57% crash. Second, a massive wave of capital was coming through government stimulus and quantitative easing. And third, most people were either too scared or too financially stretched to act. Today's moment shares the same structure, but through a completely different mechanism. The asset undervaluation doesn't apply in the same way right now. Markets aren't crashed. But the massive wave of capital, that's the $124 trillion transfer, and it absolutely dwarfs anything any government has ever done. To put it in context, the entire pandemic relief effort across all programs totaled approximately $5 trillion. The wealth transfer represents 25 times that amount flowing through the economy over the next 2 decades. And just like 2009, the overwhelming majority of people don't know what's happening. The Great Wealth Transfer receives a tiny fraction of the media coverage given to daily stock movements, even though its economic impact over the next 20 years will be far more significant. People who became millionaires after 2009 weren't smarter than everyone else. They were just positioned when the opportunity arrived. The same principle applies right now. Part 4. What the movement of money actually creates. Here's the critical thing that most coverage misses when they talk about the wealth transfer. The opportunity isn't just about inheriting money. Only a small percentage of families will inherit life-changing amounts. Cerulli estimates that approximately 62% of the wealth being transferred is concentrated in high net worth and ultra high net worth households, which represent only about 2% of all households. The wealth transfer itself is highly uneven. So for most people, waiting around and hoping to inherit a large sum is not the strategy here. The real opportunity is what the movement of that much money does to the broader economy. When $124 trillion changes hands, it doesn't sit still. It gets invested, it gets spent. It flows into businesses, real estate markets, retirement accounts, and new industries. Every dollar in motion creates opportunities for people who are already positioned to capture a piece of that flow. Think about it in terms of ripple effects. When trillions flow into investment accounts, asset prices across the board go up, which benefits everyone who's already invested. When heirs purchase homes, real estate values in those markets appreciate, benefiting existing homeowners. When inherited capital funds new businesses, job creation accelerates across the economy. The wealth transfer creates rising conditions across multiple asset classes at the same time. The last time anything on this scale happened was after World War II, when returning soldiers used the GI Bill to buy homes, start businesses, and build what became the American middle class for half a century. That wealth creation event is the very reason baby boomers accumulated so much in the first place. Now history is completing a cycle, but at a scale that's never been seen before. Part 5. Where the money flows, the generational investment shift. Understanding where the money is going to go matters enormously. Research from Bank of America and Merrill Lynch shows that younger investors have dramatically different investment preferences than baby boomers. According to their studies, 72% of investors between ages 21 and 43 believe it's no longer possible to achieve above-average returns using only traditional stocks and bonds. This represents a generational shift in investment philosophy that's about to redirect trillions of dollars away from the asset classes that boomers favoured. Baby boomers favoured blue-chip stocks and bonds. Their heirs show much stronger preferences for alternative investments, direct company investments, and newer asset classes. In 2026, sectors aligned with younger investor preferences are already capturing enormous amounts of capital. Artificial intelligence infrastructure is a clear example. Companies like Nvidia have driven significant market returns as capital pours into AI development. Clean energy, healthcare innovation, and digital assets are all positioned to receive disproportionate shares of this redirected wealth over the coming decades. This doesn't mean abandoning traditional investments. It means understanding that capital flows are shifting and that the sectors which attracted boomer capital may underperform relative to the sectors that millennials and Gen Z are actively choosing. Part 6. The real estate angle. The wealth transfer is also going to reshape housing markets in ways that vary dramatically depending on where you live. On one hand, demand increases as wealthier heirs look to buy homes. On the other hand, supply increases as inherited properties enter the market. Markets where boomers are most concentrated, particularly suburban retirement destinations and Sunbelt cities, may see increased inventory that softens prices. Markets where younger generations want to live, especially cities with growing tech and services sectors, could see intensified competition as newly wealthy millennials pursue home ownership with capital they couldn't access before. The data already shows this kind of divergence. Median home prices have risen over 150% since 2000, but that appreciation has been wildly uneven by geography. Markets attracting young workers and technology investment have far outpaced markets losing population. Geographic awareness in real estate. Decisions is directly connected to long-term wealth accumulation. Part 7. The profession and business angle most people overlook. Here's something that almost no one talks about when it comes to the wealth transfer. When $124 trillion changes hands, entire industries grow specifically to facilitate that transfer. Financial planning, estate administration, tax advisory, wealth management, legal services. All of these fields are expanding dramatically and will continue to do so for decades. The share of millennial and Gen Z clients at high net worth focused financial firms grew from just 8% in 2021 to 25% by 2024. Advisors who understand younger clients' financial preferences are capturing business that will compound over decades. Real estate transactions will accelerate. Trust and estate litigation will increase. Trust administrators, estate attorneys, financial planners, and wealth managers are all going to find robust demand for their skills throughout this period. People who develop expertise in these areas, whether through career shifts or side expertise, will find opportunities to capture value from the capital that's in motion. Part 8. The spousal transfer nobody talks about. There's one more dimension of this that flies almost completely under the radar. Before the wealth moves to the next generation, a huge portion of it first passes to surviving spouses. Cerulli estimates that approximately $54 trillion will transfer to surviving spouses before eventually reaching younger generations. Of that, nearly $40 trillion will go to widowed women. This means there's a massive and growing market for financial services targeted specifically toward women who are about to become the primary managers of unprecedented household wealth. Advisors, planners, and financial services businesses that develop real expertise in serving this demographic are going to capture significant business for decades. And if you want to open your own business from zero, just start by opening your YouTube channel, since YouTube is the golden opportunity of this decade, and I can help you in my free community in the link below. Part 9. The psychological trap. Something people rarely talk about is what wealth creation events actually feel like while they're happening. The period after 2009 didn't feel like a golden era while it was unfolding. It felt like constant anxiety. Every year brought a new reason to think the rally was over. The European debt crisis in 2011, the government shutdown in 2013, the trade war in 2018, the pandemic crash in 2020, the bear market in 2022. At every single one of those moments, headlines suggested the run was finally ending, and yet the S&P 500 crossed 2,000 in 2014, then 3,000 in 2019, then 4,000 in 2021, then 5,000 in early 2024, then 6,000 in late 2024, then 7,000 in January 2026. The people who stayed, invested through all that anxiety, accumulated wealth. The people who fled to safety at each scary headline missed the gains that came right after. Goldman Sachs research shows that missing just the 10 best trading days in the market since 2009 would have reduced annual returns from approximately 17% down to approximately 12%. Miss the 25 best days, and returns get cut nearly in half. The brutal irony is that the best trading days almost always happen during the most volatile, scary periods, when fear is at its highest. The same pattern will almost certainly characterize the great wealth transfer period. Recessions will happen, corrections will happen. Headlines will regularly tell you that this time is different, and the old rules don't apply. History says those warnings will prove wrong, just like they have after every single crisis since 2009. The underlying force, $124 trillion, seeking somewhere productive to go, doesn't pause because the market drops for a month. Here's the thing that I think is most worth sitting with. The information about the 2009 opportunity was completely public. Anyone with a brokerage account could see the S&P 500 had dropped 57% from its peak. Anyone paying attention could see the market was dramatically undervalued. Veronica, the school teacher, didn't have access to any special research or insider knowledge. She just saw it and acted on it. The $124 trillion transfer is exactly the same. This isn't secret. The research from Cerulli Associates is publicly available. The UBS Global Wealth Report is published annually. The data on millennial investment preferences from Bank of America has been in headlines, and yet most people won't act on it. In 2009, fear paralyzed investors. Today, distraction and short-term thinking are doing the same thing, preventing people from positioning for a multi-decade event because they're too focused on what the market did yesterday. The people who became millionaires after 2009 weren't lucky. They were just willing to act on information that everyone had access to. The exact same thing will be true of the people who benefit most from the wealth transfer. Let me put some concrete numbers on what consistent action actually looks like. Assume you're 35 years old today and you invest $500 per month in diversified index funds for the next 25 years, roughly the duration of the great wealth transfer. At the historical average market return of 10% annually, those contributions grow to approximately $665,000. At a more conservative 7% return, you're still looking at approximately $450,000 from $150,000 in total contributions. Now add the potential economic tailwinds from $124 trillion in capital deployment. Even one additional percentage point of economic growth annually changes those projections meaningfully. A 7% return becomes 8%. The outcome jumps significantly. Increase that monthly contribution to $1,000 as your career progresses, and the math becomes genuinely striking. At 10%, you're looking at over $1.3 million. Regular people reach millionaire status through consistency alone. And here's what makes this moment in particular